Lawrence, thank you for joining me today. I'm really excited to be learning more about what Equiton is offering. For those of you watching, our great clients, Equiton is a private placement where I've been investing. And the nice thing about it is that it gives investors the ability to invest in the projects as well as other different real estate investment opportunities that we'll discuss. But what is really appealing to me is that I'm an avid real estate investor, but this allows me to invest without a mortgage. So I'm still able to invest into projects and different real estate investments. I don't necessarily get the leverage, but I've been able to use my RRSPs, which are not doing a lot for me right now in the current investments. So, I'd love to just hear about everything that you guys are working on. Give us a high level overview for our clients so they can, learn more about, I guess, different opportunities or different options for investing. And then, they can reach out to you directly if they want to learn about specific investments. But I think the most appealing thing for me and our audience is that you have opportunities that have, produced amazing returns for us to invest into projects and use our registered funds and TFSAs and different things like that. So I'd love to hear about everything you guys are working on.
Yeah, of course. Thanks for having me, Ryan. It's always good to see you again. Before we get into the strategies and the returns of our various investments, which we'll maybe cover in a few short minutes, I think it might be useful to take a few steps back and talk about this idea of private equity, right? Because really at Equiton, who we are as a firm is we are a private and passive real estate investment firm. And those are two keywords I just mentioned, the two P's, private and passive. Obviously, for our clients, this is a passive investment, meaning you are taking part in the appreciation of physical real estate assets and in the cash flows they may generate, but without any of the typical hurdles with active real estate investment. You don't need a massive down payment. You don't need to go to the bank and get financing at today's interest rates. And for my clients anyway, the best benefit we offer is lifestyle, right? You're not responsible for managing these properties yourselves. I come from a real estate background. I'm an active real estate investor and I love my properties. But after the 7th, 8th, 9th, 10th one, along with a full-time job and along with a few kids, I don't really have any interest in taking on more buildings, right? My bandwidth is at capacity. And a lot of my clients are people like me. We love active real estate investing. Our investments aren't meant to take over those investments, right? They're meant to be complementary, right? They're not competing with my personal portfolio. They're meant to be complementary. Of course, you're letting the experts at Equiton manage these assets for you. But while we're a passive investment firm, Ryan, we're also a private investment firm. And I want to start the conversation there because, frankly, a lot of the people I engage in conversations with don't have the frankest idea what a private equity investment is. A lot of the investments we're used to as investors are what we call public investments, right? Stocks, bonds, mutual funds. If any of your network or even yourself, Ryan, have a financial advisor or a portfolio manager, these are going to be the assets you're frankly most comfortable with. Private investments don't operate like their publicly traded counterparts, right? You think about a stock or an ETF or a mutual fund, and all of these investments share a common characteristic, and that is the way they're valued. They're valued based on market pricing, right? Traders that participate on stock exchanges are going to be setting market prices for all of the investments I just named, literally millisecond by millisecond, right? And the end result of that is, frankly, a lot of volatility, right? These investments are going to go up and down as the market dictates, right? With no real rhyme or reason. Now, private investments don't work this way, right? Because a private investment isn't traded on a stock exchange, Ryan, the value of a private equity investment isn't going to be determined by this, we'll call it an irrational market of buyers and sellers. And that's me being polite about it. I just realized I'm not sharing my screen just yet, so I'm going to throw it up quickly and then I'm going to continue. So the benefit of a private investment is that we circumvent a lot of the volatility, typically associated with investing. Now, the end result for my clients is an investment that is very stable and very linear with how it gives returns. And I can tell you at Equiton, we've been operating for about 8.5 years now. And no investment at Equiton, Ryan, has ever dropped in value. It has literally never happened, not in a month, not in a quarter, not in a year. We have an 8.5 year track record of delivering positive returns, period. So yes, these investments are quite stable. In terms of who we are as a firm and where we spend most of our time, we are really asset managers, right? Just like you would be if you went out and bought 6 or 7 properties yourselves. We preside over every single one of our properties and our development projects throughout that investment's life cycle, right? So today we'll do a high-level overview of our residential fund. We own apartment buildings in that fund, Ryan, and in that fund, you'll know that we manage every single one of those buildings internally. We have a team of about 190 employees, most of which are property managers, and that's where we spend most of our time. But we started way back in 2015 with some pretty humble beginnings. When I joined the firm, there were about 3 people here. It was a true startup from grassroots, and we started with a $1 million investment in this tiny little apartment building in Stratford that we purchased. Now, today, much different landscape. As I mentioned, we employ about 180, 190 asset managers. We have over 37 properties, the total value of which is about 1.2 billion with a B. And we also have about 1.1 billion in ongoing development projects currently underway, each project at various stages in that life cycle. And we are a truly international firm. We've got 3,000 fantastic investors across Canada and even internationally. I have investors from Hong Kong, of course, South Africa, and even the Middle East as well. So we're a truly international firm, and we've seen a lot of growth since our humble beginnings. This chart here is going to show you just a quick example of our capital trajectory, right? Very, very small at the beginning when we got started, and we've doubled in size, Ryan. I can't tell you how many times. Our portfolio just continues to outperform year after year after year. Regardless whether it's a bull market, bear market, interest rates are high or low, COVID, it doesn't really matter. The consistency's always been there. And I think that's what our investors have come to expect from us.
It's incredible. And is that a lot of investors that are reinvesting their capital after they realize returns?
For sure. I mean, anytime you're relatively new on the scene or anytime you're introducing a new type of way to invest to a client, it's largely an educational conversation, and it takes time to build the relationship. A lot of my clients will maybe start by dipping their toes in with a small minimum investment amount, typically anywhere around the 10 to 25K mark if you're new to the space. But then they see rather quickly the results they're getting, especially when they see other pieces of their portfolio kind of floundering or just treading water. And inevitably, we do repeat business. There's no other way to grow the way we have without it. But that's been our bread and butter. Now, you mentioned one thing at the beginning, just in your great introduction to me. You mentioned how you're an investor with us, of course, but you mentioned how you're able to leverage your RRSPs. And that is the hugest upside for most of my clients, because as I mentioned earlier, most of my clients are people like you and me, right? We're active real estate investors. We love this asset class. We have no interest in selling our properties necessarily, but we do have other capital set aside in these tax-exempt registered accounts that can't really be deployed to real estate assets, at least not physically. Now, for those situations, Equiton for my clients is a no-brainer, right? Because I'm still able to offer these investments across all those tax-exempt accounts, TFSAs, RRSPs, RESPs, LIRAs, you name it, we can accommodate it. And of course, we also do corporate investments, joint investments. We're very, very flexible that way. So any way my clients want to structure the investment, everything is possible under the sun.
And that's significant, and that's why I ended up investing with you guys. So for those of you watching this, you need to look at how much money do you have invested in your RSPs. Canadians have a lot of money invested in their RSPs. Then you need to look at the returns. I've been trying to figure out how to get my money out of my RSPs for the last 10 years because I want to get it into real estate, because I just know I'm going to get much better returns than a typical, RSP type investment, whether that's a money market fund or mutual fund. But, this has allowed me to do that. And, it's not necessarily the same as going and buying a physical property on my own and getting the leverage, but I am investing in a development that is getting its own leverage. So I am getting, significant returns, right?
Of course. Look, I've had clients try and pull money out of their RSPs a little bit early to maybe supplement a down payment on a new property acquisition, but inevitably the CRA is going to want to have a conversation with you, and it eventually just ends up not being an economically viable solution. And for that reason, these types of investments make a lot of sense, right? You're still getting that same exposure, although you're right, not taking advantage of leverage per se, but the money will grow for you, and that's what we do for our clients. So on the screen up here now, I've got just a high level overview of our investments. And we're a very simple firm, Ryan, you already know this. We have 3 different investments, but to make it even simpler, you can think of Equiton's offerings broken into 2 categories. On the one side of the fence, we have real estate funds. And on the other side of the fence, we have real estate developments. That is it. Funds, developments. We'll talk about the funds together first because they share some common characteristics. So first of all, our funds are diversified, right? Think about investing in an ETF or a mutual fund where a single investment is actually going to give you exposure to multiple stocks, or in our case, multiple properties, right? And that diversification, of course, lowers risk. So funds are very appropriate for maybe older investors, maybe investors with a low risk profile, investors that don't necessarily want to see a lot of risk in their investments. The second thing to understand about the funds, because they have a buy and hold strategy to them, these things are cash flow machines, Ryan. They pay monthly cash flow to investors on the 15th of every month. It has never been missed, that distribution. It's never been lowered. It's paid out like clockwork. And of course, this is coming from the rental income on our buildings. And the last thing I'll say about the funds is that they're flexible, right? You can make an investment today into that fund. Then after 3 or 4 months, once you develop some comfort, or maybe you get a big bonus at work, or you make that RRSP contribution, we can do subsequent investments into the exact same assets. So you can grow your position over time. And similarly, you can scale it back over time. But it has the flexibility of a stock, except we're investing in physical real estate. That's the benefit of the funds. Now, forget about the funds for a sec. Let's talk about the big boy on the far left, or sorry, the far right. 20% annual returns. This one gets most people's attention. These are the development investments. Now, with the development investment, it's completely different. It's not a buy and hold strategy we're executing. It's not a diversified fund. With developments, we're investing in the physical construction of a real estate asset. 90% of the time, that asset is going to be residential, and specifically a condo. And we are profiting when these assets are completed and sold. So with these developments, there is a finite lifespan to that project. Projects can range in length anywhere between 3 and 5.5 years, of course, depending on the size of the project and its geographic location. And we are profiting upon the completion of that project. So the returns come at the end of the project's life. Now, the first thing to understand about these developments is that it's not a fund. You're investing directly into a specific project, whether it's a condo we're building in Toronto or a subdivision of homes out in Guelph or whatever the case may be. So you're not getting diversification, you're getting concentration. The second thing I'll say is that, again, you're not getting any cash flow. Your returns are given to you, the investor, at the end of the project, Ryan. So if it's a 5-year project, you're not getting any returns from us until the end of year 5. You're getting a lump sum cash payout. And at the end of that project, the investment closes, right? You're getting back your original invested capital plus all returns, and we literally close the investment.
So you're essentially a partner.
You are our partner, exactly. We have skin in the game when we build a condo, and our limited partners, which are our investors, are participating in the profit of that deal right alongside us. We are the GP, the general partner, meaning we preside over the operations of the project, but our LPs, they stand to profit in a huge way from the completion. That's exactly how the investment's structured. The other thing I'll say, and I think it needs to be brought up, is that unlike the funds, which are quite flexible, the developments are kind of inflexible. They're illiquid, which means you can't sell them. So once you're on, let's just say, a 5-year project, you can't decide 3 years in that you changed your mind and you want to sell your investment. Once you partner with us on a deal, we don't exit the deal ever, and we expect our investors to not exit that deal until it's done as well. So for those reasons,
it's great for RRSP money because you're that's typically going to be in there for a long period of time anyway.
You hit the nail on the head. With development investments, 90% of my clients are doing them in their registered accounts because, like you mentioned, these are long-term investments anyway. If you're in your 30s or 40s or 50s, you don't need this money for 15 to 20 more years regardless. You might as well have that capital compound on itself as many times as possible. And that's what these developments offer.
You typically see investors who are using registered funds go into the development funds because obviously the returns are higher. There's really no need for liquidity or anything.
That's usually what I'm recommending. The only way I would say I have a hard time recommending that is if I'm speaking to a client that is very, very green or maybe has a very a very high aversion to risk. So they're not comfortable with risk. Or if they're frankly older, right? If they're going to need this money in the next 2 to 3 years, maybe they're in their mid 60s, they intend on drawing from their RRSPs in a few years, Ryan. Well, then a 6-year project doesn't make a lot of sense for them, right? And that's where I spend most of my time. It's getting to know my clients, educating them, and then advising them the best way to proceed, right? Now, in terms of our minimum investments, our bread and butter at our firm was built on having very, very low minimums. Now, typically, private equity investments are relegated only to very sophisticated investors, ultra high net worth, frankly, the 1%ers of the world. And the minimums typically reflect that. That isn't the case at Equiton. We have investment minimums as low as $10,000. So we have highly sophisticated clients with millions of dollars with us, but we also have that younger investor who's super passionate about real estate, who has some capital in his RRSP and just doesn't really know what to do with it, doesn't really trust the stock market, and everything in between. So our minimum barriers to entry are very, very low. Anyone can participate in these things. It's always worth having a conversation to learn what we can do.
And the reason why I really like these investments for our clients is, the registered thing is huge because you just don't get returns outside of real estate, the way you do with real estate. But what I really like about these other funds and the liquidity is that if you don't have enough right now to go buy a pre-construction condo or a multiplex or whatever physical asset that you want, this gives you the ability to get high returns in real estate, come up with a plan. So we're working with clients right now who are investing in these types of funds, where then we've got a plan to buy their first investment property in 2 years or a year and a half or something. So it just gives them those returns and the liquidity to be able to, function and be able to invest.
Even if it's a temporary investment in a little bit of a holding pattern while you're waiting for that next big opportunity to come by, that's also a common occurrence with my clients, right? Why don't we take a deeper dive into some of the investments just at a high level? I don't want to give too much information because there is a lot to cover, but we'll just touch on each investment very lightly, and we'll go through it. So I want to start with the residential fund. This is our most stable investment at Equiton. This is our flagship fund. This fund alone has about 1.1 billion in it. So very, very large fund. And strategically, it's a very simple investment to understand. It is a long-term buy and hold approach to residential real estate investing. So that's frankly, Ryan, what you and I are doing, right? We own a series of multifamily properties, whether they be condos, towns, or fully detached homes. We're renting them out. We're taking in that cash flow. We're paying off the mortgage a bit. We're refinancing them, rinse and repeat. That's exactly what we're doing with this fund. This fund owns 37 apartment buildings, valuation over $1 billion, with over 2,700 individual apartment units. Now, our vacancy rate is about 1.2%. So we have very, very high tenancy, which makes these 37 buildings cash cows, right? They spit off monthly recurring revenue like nobody's business. And because of that, we pay pretty high cash flows to clients. We're paying roughly a 6% cash flow, and it's distributed to investors every month, right? Just like your tenants are going to pay you monthly rent, hopefully on the first of every month, we're going to do the exact same thing without fail. So our investors are getting the cash flow generated from the buildings and the appreciation of the buildings, right? As the value of those 37 buildings increases over time, so too does the original investment made, right? So we've mirrored the core value propositions of a buy and hold strategy, but we've created a synthetic fund to do so with much more flexibility. And of course, you can use your registered accounts like the RRSPs, but that's really all it is. It's a long-term buy and hold approach to residential real estate. This fund 5-year average annual return is 10.5% approximately, and it hits that 10.5 with remarkable consistency. As I mentioned, it's never dropped in value, never in a month, never in a year. It's never happened. So it is very, very stable with how it delivers those returns. Any questions, Ryan, or shall we move on to the next one?
Yeah, let's move on. That's great.
Let's do it. So our second fund, we do have two funds. This one is meant to be a bit of a hybrid investment. So this one sits in between our very stable, very low risk residential fund and our higher growth development projects. And it has elements of both inside of it. It's called the Income and Development Fund. And it's meant to be a jack of all trades vehicle. Just like the pie chart in front of you is showing, it's invested partially in very stable income producing assets. So there is a monthly cash flow component to this investment, but the majority of the fund is invested, Ryan, in multiple development projects, not just one. So you're getting diversified exposure to every single development that Equiton engages in a much more flexible form factor, right? Now, the developments in this fund are put in on a revolving door basis, which means currently there are 4 projects in the fund. As 1 or 2 finish, we're going to add 1 or 2 more. So you're always going to get exposure to developments nonstop, and you're always going to see these high profit events coming when we turn over those projects. And then, of course, they're replaced with new ones, rinse and repeat. So this fund has that very stable 6% cash flow, but it also has this incremental upside, this pop in returns, if you will, coming from the completion of these very large developments. Now, the developments in the fund bring up the return. So the targeted return for this income and development fund is a little higher than the Resi fund. It's 12 to 16%. And just like the Resi fund, this thing is stable as ever. It's never dropped in value. No investment that Equiton has. So it has a pretty good track record of delivering those returns. Now, what I think...
Do you typically see investors reinvesting their dividends, their cash flow?
Yes. All of our cash distributions paid monthly can be reinvested. There's no cost or fee or anything like that for doing so. The majority of my clients will take advantage of our reinvestment program, especially if it's in a TFSA or RSP, right? You don't really want to touch that capital. You want it working for you. So we automatically put it back into the fund and it starts to compound on itself. Right?
Of course. Yeah. The compounding effect is great. I'm curious, are there some, and maybe you're not allowed to talk about this, but are there some investors, high net worth people that, invest in a fund like this and then use the dividend as a way for income?
A huge portion of my clients do that. I'll give you an example of the type of client that might do that. Look, maybe you're in your mid 60s, you're approaching retirement, or you're in retirement.
Yeah.
You've been lucky enough to enjoy some success in life. You've got a lot of financial assets, which means you have a big portfolio at Equiton, but you're approaching retirement. You want to spend time traveling in Europe or going down to Florida or spending more time with your grandkids, whatever it is you want to do. The last thing someone like that wants to do is manage a portfolio of 25 active real estate projects, right? They don't want to manage 13 buildings. They're trying to simplify their life, in other words. They're not trying to complicate it. So I have investors with multi-millions in the residential fund or this fund, and it's kicking off to them anywhere between $4,000 and $7,000 a month in cash flow. They don't have to do anything. They're leaving it to the experts at Equiton to manage the investment for them, and we're putting a check in the mail on the 15th of every month like clockwork, right? Yeah. So that's the upside.
I'm looking forward to those days.
Yeah, true passive income. Yeah, because anyone who says managing properties is passive income has never bought a property in their life. I always tell my clients, being an active real estate investor, I love it. It's great, but it's a part-time job on a good day. And on a bad day, it's a full-time job or worse, right? Which is good when you have the bandwidth and the time, but when you're trying to simplify your life, it may not make sense for a lot of folks. So we just
we do our best at making real estate simple. We manage a lot of our clients' units, and like my management company manages all mine. But the reality is, I still have to think every month about cash infusions, or my low rise having issues with floods, and like there's still those things. So I think ultimately everyone wants to get to the ultimate passive.
Set it and forget it.
Yeah, exactly.
Great. Let's talk about the developments, because I feel like members of your network, Ryan, are going to appreciate the developments the most.
That's what I'm investing in right now with my RRSPs.
Yeah, exactly. So 1099 Broadview. is our current project. As I mentioned at the beginning, we do one project at a time, so it's not a fund. Typically, we're building condos, everyone. So this project is a 12-story condo we're building in Toronto's East End. The closest major intersection is Broadview and Danforth. The actual address of the building is 1099 Broadview. It's a 1.4-acre parcel of land. We are developing from a commercial retail plaza to this 360-unit 12-story condo. The term of the project is approximately 5 years. Now, we started this project back in February. So at the outset, it was 5.17 years. Now I'd say it's closer to about 4.9. It's coming up for completion in Q1 2029. Okay, so it's about 4.7 years from today. And the total ROI on this deal is 103%. 103. And if you divide 103 by 5.17, you can do it yourself. For everyone watching, you're going to get an average annual return of 20%. That is what we're offering.
You're going to double your money.
And that's exactly it. The rule of thumb in the development industry is that a 5-year project, if everything goes according to plan, and a lot of them do, we're doubling our money. Our ROI is around the 100% mark. So imagine that 100% return compounding on itself after 3 or 4 projects, right? You put in 50K, it goes to 100, then it goes to 200, then it goes to 400. And all of that.
I just think about my RRSP money, how it's just been performing for me over the years. And if I had taken a couple $100,000 in RRSPs, done this 10 years ago, doubled. I mean,
you'd be in 7 figures easily, as long as you have the time, right?
Awesome.
And that's what we want to do for our clients. The minimum investment is 25K on our standalone developments. So it's not very high. Most of everyone can participate if we've been contributing to our RSPs for the past few years. Typically, folks have 25K to invest. And we do the entire project management internally at Equiton. So Equiton Capital, which is my firm, we raise the capital for the project. So this project's going to take us 32 million of equity to raise. And we have about 4 million to go. So it's almost full. I suspect it'll be full in about 4 to 5 weeks. But Equiton Developments, our development division, is going to preside over this project from start to finish. We do all of our own developments internally. And this is important to understand, because if you're going to partner with a firm, you need to know who you're partnering with and the value proposition they offer, because a lot of people are trying to develop condos these days, and some are fantastic owner operators, some are not. Some have never done this before. Some are taking a chance. Equiton has tons of experience doing this, you guys. We have a track record of success. And most importantly, I'd say in today's market, we're very well capitalized. And that's important today to understand, because given where interest rates are at, and given the cash negative nature of these types of investments, right? We're spending a lot of money up front to build a condo. You need to make sure your partner, your GP, is highly liquid, right? That they have access to cheap capital, so that projects don't end up sitting on a shelf for longer than they should, getting postponed, or at worst, getting delayed, or getting kiboshed completely, canceled. We've never had a delay on a project. We've never had to cancel a project to date. And that's because of how well capitalized we are. So if your network, Ryan, are considering other development investments as well, I think it's a great thing. There are other fantastic companies that do what we do, but do some background on the firm you're partnering with. That would be my parting advice to people. You really are a partner.
It's never been more important than now to do that due diligence or have that knowledge. And, that's why I'm putting you in front of our audience, because I know you guys are so well funded, and, I don't have that concern. Lawrence, we're going to leave it right there, because, I just wanted you to kind of touch on the different opportunities. So many of our clients have been asking me, Ryan, what can we do with our RRSP monies, our registered funds? And, I'm thrilled to be investing with you guys now. So I just wanted to bring this opportunity to our clients. We'll leave it at that. I will share this video with everyone. Anyone who watches this, please reach out to me. I will make an introduction to Lawrence. You can go through all of those investments in more detail. what is the best way kind of moving forward if anyone's interested in potentially investing?
If there's any members of your network that are interested in learning more about what we do, please reach out to Ryan and he'll set up a meeting with myself. It'll be me personally. I'm not going to pass you off to one of my junior associates or anything like that. I deal with all of Ryan's referrals personally, and it's a personal business we run here at Equiton. The last thing I'll say is this: if you're unsure of whether or not this is something that's appropriate for you, you don't really understand a lot of what we talked about today, have an educational call with me, right? And my calls are just that. They're meant to be educational. And by the end of that 1 hour meeting, you're going to have a much better understanding of whether or not this even makes sense for you, right?
Yeah, that's great. All right. On that note, thanks for your time, Lawrence, and we'll be in touch soon.
Pleasure's mine, Ryan. Take care.